My name is Yuning. I'm the co-founder of Endowus, and with us we have Budget Babe, Dawn. Very quickly, let me put my slides on up and go right back to the start. Well, thanks for joining us this evening. My name is Yuning. I'm the co-founder of Endowus, and with us we have Budget Babe, Dawn. And I should definitely be muting that. Great. So apologies, I'm a noob. This is my first time at it, so thanks for joining us tonight. And again, Yuning, co-founder of Endowus, we have Budget Babe, Dawn. Tonight's talk, family finances, sowing the seeds for the future. I'm a new parent and an existing one, I guess. I have a 2-year-old and a 3-month-old. So I guess that qualifies me as a resident expert within Endowus to speak about this topic. Dawn, why don't you introduce yourself very quickly for our audience tonight? Dawn, I think you're on mute.
Right. Hi, everyone. My name is Dawn, and I run Budget Babe. So I have been a parent for about 1.5 years now. I actually gave birth end of 2018. It's been a very different investing journey compared to investing for yourself when you have your kids involved. So yeah, we're going to be sharing a little bit more about that. And I think today's webinar is going to be quite interesting because Yuning and I have very different approaches towards investing, and it's going to help you guys better be able to decide which approach is good for you, because at the end of the day, the best kind of investing is one that works for you. And I think a lot of people don't focus too much on that. A lot of focus gets put on the methodology and the approach, when in reality, it should be the method that works best for you given your schedule, your time, your risk appetite, and a lot of other qualitative factors that don't get enough attention. So hopefully today, as we share about our 2 different approaches, it'll help you guys to make an overall decision and help to manage it better. And if you have any questions, just let us know on the YouTube chat. We're there monitoring, and we'll help to address questions as and when.
Yeah, that's a great point. That's a great point, Dawn. Thanks for highlighting. If you scroll down a little bit, you guys can feel free to put in questions, comments, say good or bad things about us. We'll listen. If you scroll a bit further down, a few of the links we've referenced will be there as well. So if you're interested in reading some of the articles or accessing some of the sites we've highlighted, please feel free to do that as well at any point during the talk. So just to highlight, our next talk will be on Wednesday next week at 7 p.m. So please feel free to join us to listen Greg and Sam speak. And so I think, disclaimer as always, so please read and buyer beware. So really quickly, just to introduce myself again, as mentioned, co-founder of Endowus, parent of 2. I started my journey in investment and finance probably when I was in school back in university. Since then, I've spent most of my time in the investment world, investment banking, private equity, hedge fund, family office. And I started Endowus because when I first moved back to Singapore about 7 years ago, I found investing here very difficult, very expensive. And I thought that there had to be a better solution for everyone. So we started Endowus with the hope of making a high quality retirement and easier, higher quality investment products available for everyone at lower cost. But anyway, moving on, we have a really cool talk tonight. Dawn will be going back and forth and again, adding in any questions the audience has. So again, just a reminder, please feel free to add in. Hey, Derek, nice to see you. How about we have, Derek's asking how old our kids are. Again, 3 months and 2 years. How old are yours again, Dawn, did you say? Sorry, Dawn, you're on mute.
Never asked a woman her age, but my kids.
How old are your kids?
1.5 years old.
1.5 years old, that's right. So, pretty good age, all around the same, Derek. So today we'll be covering a few different main points. I think we'll be talking a bit about downside, goals, knowledge, tips, time, execution, and resources. And again, a quick overview of the talk is also, if you scroll down a little bit. Dawn, do you want to walk us through at a very high level, sort of how you think about what we'll be talking today and why it's important for everyone to listen?
Yeah, definitely. So to help make this a little bit more structured, we have actually come up with a 5-step framework to help you guys through this journey. So the first thing we're going to cover is on the downsides, and then followed by the goals and how you're going to incorporate that into your whole evaluation framework, whether you want to go method A for investing or method B for investing. And then we're also going to talk about knowledge, time, and tips, which not many people really address when it comes to choosing which sort of investment methodologies to apply for yourself and your child. After that, we're going to share about the execution, and this is going to be the interesting part because Yoning and I had very different methods on how we approach this execution. So you're going to hear both sides of the spectrum. And then finally, we'll end off with a lot of other resources that you guys can go to if you want to understand and learn a bit more before you start your journey.
Great. So let's get started. And I think as a good investor, you always got to watch your downside, right?
Yes, correct. So I'll go on this part. I think the most important thing before any of you even start investing is to first take care of your downside. And we really cannot emphasize this enough because if you don't clear off your debt, especially your high interest debt like credit card, if you don't take care of your insurance, then you might end up having to take out money from your investment portfolio to pay for stuff like that when unexpected events happen. So the way I approach insurance is basically outsourcing the biggest financial risk that I wouldn't want to pay by myself. So obviously that's going to cover the hospitalization bill because we know medical inflation in Singapore is just insane, and I don't want to have to pay for like, a 20,000 bill just because something suddenly happened. So I don't make sure that just myself and my husband are covered. We also want to make sure that our child's hospitalization insurance coverage is there, and whatever you feel is necessary because you don't want to take on that risk, then look at what you can outsource to an insurer. And of course, please make sure that premiums are something affordable because as much as we want to outsource every risk, we also have to pay a fee for that outsourcing. So balance it between what you can afford as well as the risk that you ideally want to outsource. So we're not here to give insurance advice, but just to share for ourselves, I try and make sure that myself and my husband, we are covered for hospitalization bills, critical illness, we have term life insurance, and we also have personal accident insurance. As for my kid, what we chose to take on was hospital, critical illness, as well as personal accident. Yeah, we didn't opt for term or life for our child because we didn't feel was necessary. But for some other folks, depending on their circumstances, that might be important. So please go and speak to a financial advisor about that. And on top of that, we also make sure that our parents are also covered because I think the key thing is, our money is not just for ourselves, right? At the end of the day, we're to balance the funds that we have in taking care of ourselves, our parents, as well as our child. So first look at the risk and have that covered with insurance. Now, the second thing you want to make sure is that you have an emergency fund. And I think, what's interesting is that with COVID-19, we're starting to see that a lot of people, as well as businesses, apparently don't take and heed this HO attached enough. It's so important because you never know what will happen. Suddenly, there might be something that could come up. For example, you might have a burst pipe and you need money to go and pay for the repair, or you might suddenly have to pay for a bill that you completely neglected, or something breaks down and you need to get a new fridge, stuff like that. Or even worse, you might be laid off from your job, or you have to take a pay cut. And if you don't have an emergency fund to fall back on, then you might end up drawing down from your investments. And that is the worst thing to do because you never know when the market could be good. When you need the money, it doesn't necessarily mean that your investments would be at a good time and place to be withdrawn. So ideally, taking care of these things first is the key things that you want to do. Yoning, is there anything you want to add on that?
Actually, I'd love to ask you a question there. I mean, how would you think about how much sort of emergency or rainy day money you need to set aside?
I think it really depends on each person's expenses. I think the general consensus is saving 6 to 12 months of your salary or 6 to 12 months of your living expenses. For myself, we actually use 1 year because we have a few more liabilities to think about. We have 7 dependents between myself and my husband. So just putting 3 or 6 months wouldn't be enough for us. So I think it's really an open number, right? For me, I choose 1 year. I know of friends who do 6 months. What about yourself, Yuning? What do you think is a good number?
I think 6 to 9 months is probably a good number for most people. For me, I'm quite fortunate. I don't have to take care of my parents, so it's just my immediate family. Both my wife and I work, so obviously this rainy day fund also, in case anything unfortunate happens at work. So right now, since we're both working, there's sort of there's a safety net in some ways, but you never know. So I think 6 to 9 months is good enough for us at least. But I think that's a very good framework to think about it. How many people are you taking care of? What your recurring expenses are. It takes a little bit of thinking to really get this right, but absolutely the right thing. The first thing you have to think about is sort of what's your downside, what can go wrong. And honestly, some of the best investors in the world, that's the first thing they think about when they look at individual investments as well. And I guess we look at our own lives. I mean, that's probably where we should start.
Mm-hmm. Yeah, exactly.
Yeah. So I don't have much of value to add on top of that, but for me, I think sort of what Dawn mentioned is sort of great defense. I think if we use a soccer analogy, I think in life you're going to play great defense as well as great offense. One thing that a lot of people don't realize is inflation really eats away at your savings. And inflation in Singapore, has been moderate, but hasn't been that low actually. It's been a bit higher than bank deposit rates and things like that. Singaporeans tend to have a tendency to leave too much in cash. So one of the things that I think, if you want to make sure that you're well set up for the future, to play good defense, you got to play a bit of offense. And one of the things to highlight that is if you look at this price chart, this is from Seedly. If you remember movie prices when we were in secondary school, it's probably like $5, $6 for a movie. These days it's like $12, $13. Everything has gone up in price. So if you really want to be thinking ahead of the curve and want to play good defense, your money, if you just leave it in bank, won't be worth as much. So I think that's one of the downsides that you really need to think about as well. So just my 2 cents. Goals.
Exactly. So the next step, so after you've taken care of step 1, which is making sure your downsides are already catered for, the next step to really think about is what exactly is your goal? What makes you want to invest? Right? You must have an end goal in mind. As my high school principal used to tell me, if you fail to plan, you plan to fail. And I think that is really great wisdom. It applies in investing as well, because if you don't know what is your end goal, it's very hard to really find which strategy, which approach, and what instruments will work best for you. So here are a few goals that we'll talk about. I think for myself and my husband, we are looking at getting financially independent to a stage where we can potentially retire early, although that's not the main thing. The main key thing is to have financial independence and freedom. Because growing up, money was always a problem for me and in my household, and it was to a stage where we had to make decisions because we had no other choice. We just didn't afford. We couldn't afford to pay for certain decisions until our choices were limited. So being able to have financial freedom to make sure our retirement is taken care of, that's a really important goal for myself and my husband. And I think I saw this really great ad campaign that talk about how we can be the last sandwich generation if we take care of ourselves. Because I think right now, in Asian context, right, Asian families used to be really big. When my husband's grandma was actually hospitalized, the bill was just exorbitant. But the good thing was because, when there's a lot of children, a hospital bill that is like 5 digits or even 6 digits can be divided by more people. So it's not that painful. However, things have changed, right? Because ever since it had the Stop at 2 campaign, household size have actually become smaller. And so the burden on us is actually really high. Like I'll just use myself and my husband, for example. We're just 2 people, but we have to take care of 4 adults, right? Like both sides of the family. And my husband's an only child. So there's no one else to split the bill with. So it's really a lot more painful. And when you couple that with the fact that Yoni mentioned inflation is up on the rise, medical inflation is one of the fastest growing area aside from weddings. And, that is going to be even more painful for us in the future. So I wouldn't want to impose this burden on my child. And the first step, I think, is really to take care of our own retirement. So that's one very big investment goal. The next goal, many parents also have the wish to be able to provide for their child to go to university. And depending on whether you want and you aim to go to, your local universities or overseas, if you want to give your child the ability to take on a medical degree, if they want to, then that's going to cost you a lot more as well. And if you want to be able to save for that, it's going to be really, frankly, quite hard. Because you couple in the fact that with inflation rising and how our wages are not growing fast enough to keep up with that, as well as educational inflation, it's going to be really hard for us to keep up with it. So that's why you may need to look at other approaches we will talk about, especially in investing. But saving for your child's investment fund is a very common goal that many parents have. And that might be the reason why you're watching this webinar today. So if that's your goal, great, keep that in mind. Now, another one could be, for example, some people have really short-term goals, right? So they just want to save up a sum of money or hit a certain financial milestone so that they can maybe quit a job and go for a 1-year tour around the world. That's fine as well. No one's judging your goals, right? As long as it makes you happy, as long as it works for you, that's good enough. But, if your goal is a little bit more short-term, then, the instruments that you might choose will be very vastly different, right? You may not want to risk it on things like options or trading or forex or cryptocurrency if your goal is more longer term. or you might allocate a smaller percentage of it. But let's say if you're like very, very close to retirement, it's very unlikely that you would want to risk so much on debt when the risk is much higher. But if you're saving up for something short term, then the kind of risk appetite that you have and the instruments that you may go for might be very, very different. You might be willing to go on more speculative approaches because what do you lose at the end of the day? Simply a vacation. But if you are investing for the goal of your own retirement and your child university fund, losing that is a lot more painful than a simple vacation. So as a result, you might want to think about taking on lower risk because your goals are a lot bigger, and as a result, you would adjust the methodology accordingly. Yeah, I mean, these are the most common goals. Yoning, what about yourself? What is your main goal when you invest?
Yeah, no, I think you've touched on it exactly right. I mean, I think it's for retirement. I think it's for my children's future education. I mean, I would love to be able to, help my children pursue any education that they choose, be it local or overseas. I would obviously love to help them eventually as they start up, to give them the freedom to pursue the career of their choice. I mean, some pay less than others, but at the end of the day, I always believe that you should follow your passions. I would love to be able to provide that option and that optionality for my children. So it's number one, making sure that I'm okay, so they never have to worry about me, just like you said, and then on the back end, giving them some of that flexibility to really pursue their dreams. But actually, a totally random question for you. I mean, you're super educated on this topic, and frankly, you look very young. Again, you mentioned a woman's age. How did you get into this? I mean, when you first started, I mean, how did you get on your learning journey? Just curious for the people that have not much time, but really want to learn a bit more. I mean, how did you get on your learning journey?
Yeah, I guess like for people who are not familiar, so hi, once again, my name is Dawn and I'm Budget Babe. So my story is that basically I grew up in a middle income household where after the Asian financial crisis, money was a huge problem for us, right? Because my mom got retrenched and she had to go around borrowing money from credit cards, from family and friends. And it was really painful. My parents also didn't have the finances to send me to university. So in the end, it came down to choosing either my sister or myself. And after making me, I wanted to go to Polytechnic actually because I already knew what course I wanted to take. But my parents persuaded me to go to JC, saying that it would be better and it's easier to get to university. And then after that, they said like they couldn't pay for my university. So I was like, what? I should have just gone to Polytechnic right from the start, right? And so it was really painful having to grow up and not have the money for that. At every stage of my life, it was always money being a limiting factor. I saw my mom and how she struggled after she lost her job. I saw how difficult, and it was really difficult for me as well. I was really, really thankful at the end of the day that I managed to get a scholarship because by God's grace, I somehow got straight A's for my A levels, and no one expected that, not even myself. I think if you talk to anyone who knew me from JC, they'll be like, yeah, no one expected her to be the top few students, right? So I was really lucky, and because of that grade, I was able to fund my university. And then there was the next stage, right? I wanted to go on exchange because everyone says you should go to exchange. You'll change your life. You'll learn a lot of different perspectives, and it's great to add to your whole portfolio and resume. So exchange is not cheap, right? Unless you can go to a developing country and be cheaper. But for the course that I was studying, the people writing my textbooks and the ones who were really established in the field were mostly in the US. And that's where I wanted to go. I wanted to learn from the best, right? Wow. And that cost a lot of money. I still remember how much it was. I had to save up $16,000. Wow. And then later on, when I was on exchange, I got even greedier, right? Everyone was saying China was the next superpower. So I wanted to get a stint into China, but unfortunately, there wasn't that option for me in my course, in my university. So I actually did an exchange through my exchange university. So I signed up as an exchange student in my US exchange university, and I got into Tsinghua Daxue, which is
I think that's called gaming the system.
Yeah, so Tsinghua University is like known as the Harvard of Asia, right? And I was like, well, if I can't get into the real Harvard, then I might as well get into the East Harvard. It's not too bad, and it's a great place to be. And that really changed my life perspective. But all of it needed money. And it was really tough for me because when I was on exchange, I had to count every single cent. I had to make sure that I didn't run out of money because unlike many of my friends, I didn't have that option of just calling home and say, hey, mom, hey, dad, I ran out of money. Can you transfer and wire some money over to me? I just didn't have that option. Everything that I had was what I had to get through. And if I ran out of money, then I would just be like, I don't know, eating bread for the rest of my exchange, right? And that really got me thinking and realizing that I had to be in control of my finances, and I didn't want to be held at that stage forever. I wanted to break out of it. So when I first started by saving aggressively. I've never been much of a spender. I don't believe in branded stuff, and that really helped me to save up a lot, especially the moment I graduated. But after that, once I had a sizable sum, I really have to thank the readers who supported me right from the beginning, because it was them who told me that now that I had $20,000 saved up, I should start investing that. And that was how I got started on my investment journey. It's been great. I've learned from so many people. I've gone for so many courses, practiced and learned. I've won some and lost some. And that whole journey really has shaped me a lot in terms of my investment approach, my style, and even in the temperament. Because I think that doesn't get enough focus as well. You can look at two people. When it comes to active stock picks, for example, right? You have two people investing in the same stock, but one makes money whereas the other one loses. And at the end of the day, what makes them different? Well, the way they handle the investment or temperament could be that different. So yeah, that's my backstory. That's how I got started. And yeah, I didn't actually study finance. So as I always say, if I can do it, and I'm not fantastic at math, was my weakest subject, but if I can, then I believe that everyone else can as well. It's not as hard. It's the inertia of getting started that's more hard.
And to your point about two people buying the same thing and having very different outcomes, I have a slide to speak to that about later. Moving on a little bit, I think you've highlighted really well sort of how we should think about goals and potentially what goals people may have. I think if we take a step back, I mean, once you've worked that out, to me the first natural step is, okay, so what do you need to get there? I'm more of a numbers guy, so this is a very simple example of potentially how you can think about what numbers may be right. And again, this is just a generic set of numbers, and feel free to punch in your own. But so if we think about what we spend every day, every week, every month, what do you need on a monthly basis? What do you need on an annual basis? House payments. Some people want travel, right? Meals in, meals out, general household expenses. Let's say you need 100,000. Let's work backwards from that math. If we think about what a realistic rate of return that is relatively conservative, in my view, it's about 5% a year if you're investing well. But if you take inflation out of it, and I think for most people, we want to be able to leave something for our children. If we want to make sure that our money lasts and we sort of outpace inflation, I think inflation in Singapore goes anywhere between 1.5% to 2.5%. So let's just use 2% as an example. You need a real return of about 3% per year. So if you're trying to solve to 100,000 per year in retirement without eating into your principal and being able to leave your children something, it's actually a pretty substantial amount of money that you need to have set aside for your retirement portfolio. This is what you need to have by the day you retire. So I think the first question and the first thing that everyone needs to do after sort of figuring out the broader plan is to sit down and really work through these numbers with their significant other, thinking about needs. So one other thing to think about is, your investment portfolio wealth. I mean, what is it really comprised of? I think for most Singaporeans, property, CPF, cash, and the investments that you have, this is sort of what constitutes your wealth. Obviously, against that, you have to net off any obligations or loans that you have as well. And that's sort of what you think about what you have to set aside to invest. But in reality, for most Singaporeans, property doesn't really count against it, because you live in your property doesn't really generate much income. So when you really think about sort of what's your investable base, I think you take that out of the equation, you put in your CPF, cash, and investments. And another thing to think about is, on top of that is, as I mentioned, you have to take your obligations out of it. So it's sort of your positive assets and then what you owe people. So that's what you have to invest with. And then you also have a personal income statement, what you need to think about ins and outs. So you have a stock of assets, and then you have flows in and out every day, every month, every year. Some general things, your salary, other income, maybe from property investments, from dividends, gifts, generous parents, who knows what people have. Spending, you take away your spending from that, your monthly recurring expenses, and any payments that you have for your loans. And that's what you can think about in terms of how much you can add to this basic collection of assets that you have, and how that will accumulate over time. So what you have versus what's flowing in / out every month. So that's something that's good to sort of just pen down and think about when you start thinking about your financial plan, I think, going forward. And it's particularly complicated for parents, because you've got to start planning for your children and thinking ahead in terms of what expenses will be. And they change a lot as your kids get older. The expenses change a lot. It goes from buying milk powder and diapers to, I'm sure, paying for tuition and tennis lessons and things like that, right? So I think, Dawn, you're very active in some of these blogs and groups in Singapore. Do you have some tips for our fellow parents here, sort of where they can get advice and where they can get good tips? What it means to be a good parent and what things cost and things like that?
Yeah, I think we're really blessed because we live in an information age, and like information is so readily available, right? So if we go on to the next slide, this is probably one of the most important part in the 5 steps work, and it's something that doesn't get enough attention. So we're going to spend some time talking about this. Now, as parents, I think for those of you who, especially if you're in any Facebook groups or WhatsApp group with your fellow mummies or daddies, you probably have one of those. You'll find that you get a lot of recommendations through word of mouth or from these people or from this group, right? And that's great. But the danger at the same time is that when it comes to investing, it's not as simple, right? You can, for example, if you want to send your child to a swimming school, and most of us as parents, what we do is we go online, research for like best swimming school for toddlers or infants, or we just ask around our parent friends in different parenting groups or social media. And then they'll throw out names where they're sending their kids to, and they'll say like, yeah, it's been great, my son or daughter loves it. And then we go and try it out. And that's how parenting usually works, because a lot of us don't have a lot of time to do all that research. So we rely a lot on word of mouth and all these social media referrals as well. But when it comes to investing, it's not that simple. You could ask someone, hey, what are you doing to save up for your child's college fund? And that person could give you an answer that's very much different from the next person you ask, and the next, and the next. Or if you want to go down and be a little bit more specific, you're like, hey, any kang tao, any lobang for any stock that I should invest in now, market just crashed. Hey, oil just crashed, should I buy oil? And like someone might tell you, yeah, oh my gosh, oil confirm will recover, go and buy. Or they'll say things like, hey, SIA just crashed, confirm built up by the government, go and buy, confirm. You just think about it, when your child grows up, right, will SIA still be around? Confirm will, right? National pride. And they can say all these things, and it sounds really logical, right? At first glance, if you're not knowledgeable about investing, you don't understand, you're just like, yeah, that kind of makes sense, that logic makes sense, and you might then blindly go into this. And I think this is something that I've seen happen so much in the last few weeks, because ever since the markets crashed, a lot of these parenting groups, they're starting to see people asking, hey, which brokerage is the best to open an account? Hey, SIA can buy or not? Hey, oil can buy or not? Just crash it, negative, cannot be negative, don't make sense. Yeah, okay. So if you go by that logic, right, trust me, one thing I've always said is, you heard of the risk of buy low, sell high, but you can buy low and it can go lower. And we've seen exactly that in SIA. I warned about that a few weeks ago in some of my own webinars. And now we're like a few weeks later, and we are really seeing the effect. SIA from its peak at $10 before the last crisis has gone down to $6 at the most recent crisis, and then now they're at like under $4. So if you had invested in that, what would you have been losing? If you were investing for a child's college fund, then yeah, that's what you lost. Is anyone going to be held responsible for giving you the wrong kang tao? No. So I think that's a problem, right? And if people don't seek to understand and get themselves educated on how exactly to invest, then it's going to be a big problem, because you're going to be so swayed by all the different advice that's going on all these parenting groups or WhatsApp group chat. So when it comes to this third stage, one thing I really empathize on is ask yourself, how much knowledge do you have when it comes to investing? So you can go and learn. It's really not that difficult. But the approach that you pick will warrant very different types of knowledge. For example, if you want to go for a more passive approach, which Yoning will share later on, the knowledge that you need is probably at maybe like this amount. Okay, it's not that difficult. You do still need to study a little bit, but it's going to be easier than, say, for example, if you wanted to invest through active stock picks. Right, you need a lot more knowledge on that, because you need to be able to analyze different stocks and understand what makes them good, versus a more passive approach where you buy into a basket of stock and you're riding on the growth of the market. Now, if you want to go into options, for example, that's going to be even more difficult. Or if you want to go into Bitcoin, cryptocurrency, different knowledge is required for different investment styles and instruments. And you need to have that knowledge before you go in. Because if you don't, then as parents, considering how much attention we put on all these word of mouth recommendations, it's gonna kill you when it comes to investing. So please do not do that. I always, whenever I see those posts on the groups, I want to go and comment and say something, but at the same time, social media is just not the best place sometimes to have a debate. So yeah, I'll just look at it and I'm just like, oh dear, I really hope that the person knows what they're doing and do not just listen to advice blindly. So the next thing is also misinformation, right? We've seen now during this stage, there's so much fake news going around. And when it comes to fake news with regards to investment or fake knowledge, fake stuff, it could also hurt your returns. So for example, someone could be telling you SIA is gonna go up, right? Because government's gonna bail out. That's well, yeah, I mean, it's not exactly wrong. The government did bail it out, but it's not exactly, it's like fake in a way as well, because there's no guarantee that the stock price of SIA will go up. And there's no guarantee that while the government bails out the business, they're going to bail to such an extent that the shareholders are going to earn profits from it, right? The government is not there to save the shareholders. They're not there to give us money into our pocket. They're there to save the business. So it's a very different thing. And stock prices are not always equals to the company's business. If you look at the overall market, generally that holds true. If you look at specific individual companies, individual stocks, that doesn't always hold. So I think knowing this has to be very, very important. And I think another increasing trend is there's a lot of people manipulating social media for their own interest. Like, I think there's all the short sellers and all the people who are, let's say they might be shorting the stock, so they go and post a lot of negative and try to turn the sentiment, right? You never know if you're part of a pump and dump scheme. So how do you know if you just blindly listen to all this advice? Your friend who might be recommending it to you might not even know.
Right? Could I chip in something here actually?
Yeah.
I think one of the reasons why I've come to realize that this type of passive investing strategy, and again, we'll have a good, healthy debate about that later, I'm sure, works for most people is because of what I saw in my prior life in the US. I worked at a hedge fund in the US where literally, the amount of work that people could do on individual names is incomparable to what individual investors can do. So it's interesting to think about how much time you actually think about investments, right? Most people who buy stocks kind of go on word of mouth, like you said, right? Yeah. Think about how much time people spend investigating a stroller versus a baby stroller or something like that versus an investment that you make. I suspect people spend a lot more time on the stroller and less on the investments. But in reality, the people you're competing against are professionals who. I remember when I was at this fund in the US, we were shorting a Chinese company. And they were a good company, they're a real business, but we suspected they were inflating earnings. So what we did was we literally had private investigators standing outside every factory, counting the number of trucks going in and out, looking at how heavy the trucks were on their axles to see if a product was actually coming in and out, and trying to reconcile that back to actual fundamental data the company was reporting. The big funds today, they buy satellite data to see the number of cars that are parked in Walmart car parks. They buy credit card data to see how much people are spending in the Apple store. The amount of information that people have these days is crazy, and the informational edge they have is completely nuts. So it's very, very hard for us, especially as parents, very time-constrained parents, who have to decide between, are you going to spend 3 hours researching a stroller or 3 hours researching the next topic? And frankly, that's not even enough time to even scratch the surface on things. But like something I think you touched on just now, I think most importantly, you really have to know yourself and be honest with yourself. Do you have the ability to do this? Do you have the time to do this? For myself these days, I think from the time I wake up to the time I go to bed, it's either work or the kids. So, it's very, very little time to think about investments for myself. But I think you touched on some really, really cool points.
I think the graphic over here of the super mom, right, it encapsulates exactly what I want to talk about, which is, once you become a parent, you realize you don't have that much time anymore. And as your kid grows, that's what we do for our kids now is going to be a huge part of their memories, and it will affect them as they grow up, right? It's our job to teach them values, to spend time to give them a happy childhood. And the more time we spend on investing or researching, that's time away from our kids. So for myself, I actually do it when my child is asleep. I do it in the middle of the night. So I actually forego some of my own sleep in order to invest and research my own investments. But I can imagine not every parent might have the luxury, because I have a helper at home, so I can't afford to do that. But what if you didn't have a helper? What if you need to spend a little bit more time with your child because he or she's a little bit more clingy and just loves daddy and mommy so much, doesn't want to let go, right? So it's going to be very, very difficult. And I think as parents, when you're juggling so many things on your plate, you also have to think about your job. You don't want to lose your job. You want to be climbing up the career ranks. You want to be increasing your salary. You also need research about like which is the best tutor, which is the best stroller, which is the best car seat, which is the best like tuition center, and so many things to think about, right? And as a result, for some parents, this is why it's so overwhelming. And if you're already feeling overwhelmed, then maybe my approach might not be the best. And we'll take that in the next stage. But yeah, think about how much time you have and you're willing to put into investing. And if that time is not a lot, then you might be better off investing on a more broader index, on a more passive approach, like what Yoning personally does. So we'll talk about that. But yeah, so to end of this portion, I'll also mention, please, as parents, while tips are great to help us in our parenting journey, there's a difference between relying on tips for education, for items, or for your child's goods and services versus tips on investing. It just doesn't work that way. If it was that easy, then everyone would be rich. But investing does not work that way. Please remember that while someone can give you a stock tip or a stock lobang, they might make money, but you could be losing your money on it. And it's the same exact stock, right? So it's really important to not just act on tips. We need a lot more than that. Yeah.
Thanks for that. I think you had one more tip to share, right?
Yeah, and so this is something that Yoni and I also, when we were talking before we actually did this webinar, we were talking about like the very first thing, and if we had only one advice, what we would give, right? And the very first thing you would do as parent, if you don't remember anything else from this session, please remember at least this tip. Please go and try, if you can afford it, match the funds in your child's CDA account. So we're really lucky because in Singapore, the government is giving us dollar for dollar matching. So what I've done is I've actually taken the baby bonus that the government has given us and used that to top up my child's CDA. And so we got the full maximum 3,000, right? So right now, in his CDA account, he's already at $9,000. And I'm like, wow, really super happy. Every time I log in, I see, oh yeah, 9,000 plus, because the interest is rolling, right? And it's 2%, not that bad. So it's the first best thing that you can do for your child, because the dollar for dollar matching is almost equivalent to like 100% gain in stock markets. We could take you really, really hard. So this is the easiest, lowest hanging fruit. Please go and top up your child's TDA if you can. If you can't, you need money, take it from like your baby bonus. And if you really can't, I think there's a time frame. I think it's given out across 12 years, right? So you don't have to put it all at once, but I personally did because I rather let it grow and compound faster and earlier.
Yeah, no, absolutely. That's one of the first things I did, because I knew that if I didn't do it right away, I'd forget.
Yeah, same thing.
I have to give them credit that I think one of the first things they tell you when you have a kid and you go register your kid, they're like, oh, don't forget to take your baby bonus and don't forget to do your CDA and stuff like that. Credit to the government for that, I guess.
Yeah, exactly.
Yeah, no, absolutely. Please go and do this first thing you do with your parent.
Yes.
So I think some tips from me, and again, from an investment and more quantitative background, the first thing I'll say is you really just have to invest. We talked about inflation and how that really eats away your savings just now. I mean, I want to put that into a graph and share some numbers. If you look at what we're using a 2.5% return here per year versus 7%, which is what long-term, I think with relatively high confidence the equity markets can do, the stock markets can do. If you think about how a dollar will grow over time, it's just tremendous, the compounding effect of an additional 4.5% every year. So what this chart is showing is if you start with $1, $1 year zero, and 40 years later, the green line shows if you earn 2.5% per year, which is a CPF OA return, versus your 7% per year if you were lucky enough to put it in the stock market. And it's incredible that you end up with 13 times more money than you originally started off with. So I think the first tip that I have for parents is you really just have to invest. And that's how you meet your ultimate goals, right? And that's how I think that $3 million number I showed earlier doesn't look so scary after all, because if you can put $1 aside now and becomes, $15 at the end of it at retirement, that brings you a lot closer towards your goals. Second thing that a lot of people tend to overlook as part of these Kangtao and things like that, sometimes you hear, oh, this fund is great, that fund is great, this guy should make money on. People tend to overlook a lot the cost of investing, and that's one of the things we try to fix it in Endowers, because over time it really, really makes a difference. You saw how compounding returns over 40 years really makes a difference. And one of the things you can do to increase that return directly flows to your returns is by lowering your cost. So this is a set of research results done by Morningstar. Morningstar is the number one place that people go for recommendations on fund investing in the US. And if you look across all the different sectors and asset classes, US equities, sector equities, international equities, all the way through bonds, what they found a direct relationship between the cost of the fund, how much the manager charges you every year in terms of total expense ratio or management fees versus the returns. Consistently across every single category, you can see that the lower your cost, the better your returns. So that's another tip that I would share. really, really pay attention when people try to sell you an investment product, especially when you walk into a bank branch or something like that. Ask them how much it costs, make them show you, because those things really, really eat away at returns. I think before endowers came to Singapore, most people sort of invest in unit trusts through bank branches and things like that. You pay 3% up front, $1, then you immediately start off with 97 cents. And every year you're paying additional trailers on top of that. If you pay 2 or 3% a year in fees, you're never going to break even. So please, please, please pay attention to cost, pay attention to expenses. And quoting Morningstar again, the expense ratio is the most proven predictor of future fund returns. So please pay attention to that. And just as a very, very graphic example of what fees can do long term, I mean, your friend tell you, hey, this fund damn good, 1%, 1% more management fee than mine, the guy should make it back. But if you really compound that difference, over 30 years, if you had someone that could earn you 7.5%, 8%, 8.5%, and the 1% difference being management fees, you really would end up with 2.5 times less of your money. You start off with $1 million. If it's 8.5, it's 10 million. If it's 7.5, it's 7.6. The difference is huge. So again, a very, very small differential in fees will end up being having a very, very big impact on your end result. So please, again, pay attention to fees because of the compounding effect. So execution. Dawn, what are your thoughts here?
All right, so when it comes to execution, this is an interesting part because Yoning and I differ a lot in the execution method that we've chosen. And for myself, I actually use a mix of active investing for my own investment portfolio. But when it comes to my child, I'm a huge believer of investing in growth stocks because he has a lot of time on his side. And if I can put in the effort now to find those potential multi-baggers like the next Facebook, the next Google or Apple, next Amazon, this could become a huge, huge part of his financial returns. And so that's why I love the idea of active stock picking. I do mix it up a little bit because at the end of the day, when I talk about objective and goals, right? So I have two objectives when it comes to my child's investment. The first one is to teach him about investing. Because I think anything that I do for him is a bonus. But the biggest gift that I can give to him is to teach him how to invest by himself for his own future. Because I'm not going to be around all the time. I won't be able to take care of his finances all the way. It's better to teach him to be independent. So I have a portfolio where I actually put in the different types to show him how that has fed over the course of his life. And what I do is, for example, I invest in Disney stock. And when he's a little bit older and we bring him to Disneyland, I'll be teaching him, hey, you know what? You basically own a piece of the Disney business. Did you know that? Like maybe you can think of it as this house over here is yours. Or like, yeah, and you look at how much you love their movie. Let's see the growth of Disney. And I'll just keep, talking about him this through the different years as he grows up. So he remembers and relates and can actually feel and experience that own journey of having seen the company grow and being invested in that company's business. This is actually a tip that I learned from investor Lauren Templeton, whom I really respect a lot, and her hedge fund is great. So she shared on how she also teaches her daughter this, and it really left an impact on me. Back then I wasn't yet a parent, but when I first learned that, I was like, wow, this is really fantastic. It's something I want to teach my child as well. So that's the first objective. And as a result, I have stocks and stuff in there so I can use to show him how that has fed over the last 20 years of his life when I finally passed over the investment portfolio to him. Now, the second part is, of course, then saving up and investing that amount to give him a pot of money, probably not super a lot, but a pot that's enough to at least potentially be able to either go to university or use that sum of money to start up anything that he wants, whether it is going to an art college or a music school or even starting up his own business. It's just giving him a gift of money so he can use that to start his life with once he reaches an adulthood, right? So that's the two goals that I have, and as a result, when it comes to execution, I mix between his portfolio has stuff like cryptocurrency, which is super little, by the way, because it's more speculative. I'm just trying to show him how that would grow over the years. And then there's also blue chip, but not a lot. There's also growth stocks that I'm trying to identify, which will become a huge part of his future and can help him to understand and relate better. And then, of course, there's also the REITs, because here in Singapore, it's hard to run away from real estate, right? So that's a more diversified portfolio that I have for my child. And remember, going back to objective, I have two objectives. The first one is to educate him. So if I don't have it in the portfolio, it's harder for me to explain to him over the years. Everything else is just then on hindsight, right? And hindsight analysis is always perfect, but you don't learn as much from when you're actually invested in the markets. So I want to give him that emotional experience to train him up as an investor. And that's why objective number one is education. Objective number two is to give him a gift of money. I am of the contrary opinion that I actually don't need my son to go to university. And my opinion is that with so many degree holders out there, eventually university would not be as valuable as it is now for us. So if he doesn't want to go to university, that's fine. If he wants to, because I funded my own way through university, I also believe that if the funds eventually are not enough, if he wants more, then he needs to find a way to fund the rest of it himself. So as a result, I don't place as much objective on investing everything into like the next biggest multi-baggers, right? Because it's so easy to just do a 100% growth stock portfolio, but I don't do that because that doesn't meet my objective. Which is why in this 5-step framework, right, I want to emphasize again, it is really about understanding what goals and objectives that you want, as well as the time, the knowledge, the effort that you're willing to put in. So for my child, I put in a little bit less effort than I do for myself. And that's why our investment portfolios look very different as well, right? And he has some parts that are passive, very little, but I don't do as much as I do for my own end. Because at the end of the day, what I think about when I structure his portfolio is how can I use this to give him a gift while educating and teaching him to become a better investor. I see Zhang Ang is also asking what growth stocks or teams or investments you're buying for your child to grow the money over time. Now, I'm not going to give stock tips over here because, again, you could make and lose money even if it's on the same stock, right? But I think teams is great. So what I feel is I see there's a whole shift towards technology. There's a whole shift towards technology companies that empowers work from home arrangement, telecommunications, and internet. So the smart chip producers and processors could be another great growth area. Clean energy, solar, pharmaceutical, and healthcare is also another big growing area. And this is basically the themes that I'm looking at when I decide what to add into my child's portfolio. Yeah. What about you, Yoning? I know for yourself, you're really busy because you run endowers as well. So how do you approach your own execution?
No, thanks for that. I really love what you said about the first part about educating your kids. It sounds like your kid's going to be the next Warren Buffett. He's going to be buying stocks earlier than anyone else we know. So kid to look out for. So I think the way I think about it, maybe talk a little bit about pre and post parenthood. I think pre-parenthood a lot more fun, a lot more gambling with your money. Punting on the next hot thing. I think, having studied finance and investing, you always want to try your hand at things. And so definitely went for a lot more high octane stuff. But I think after you get married enough, especially after you have kids, it really starts to hit home the responsibility you have when you hold your kid in your hands for the first time. You really start to worry and start to wonder how you can provide for your child. So I think, this is a fun picture I pulled off on the internet to sort of show what pre-parenthood investing was like and what it is now. So, life may be a bit less exciting than these days, but hopefully the outcome will be a lot better. So, going to sort of execution, I think I want to take a step back again and talk about a few higher level things. I mentioned this early on, and Dawn talked about how two investors can invest in exactly the same thing with very, very different outcomes. This speaks exactly to that. So what you have here is a chart of the returns of an average investor versus the market. So if you look at the US market as a whole, over 30 years from 87 to 2016, the US stock market basically did 10.2% a year, but the average investor did 2.6. And why is this? Because the average investor gets greedy, the average investor gets scared. We take tips from friends when we shouldn't. The next hot thing turns out not to be the next hot thing. The thing that we thought was for sure going to fall apart and go bankrupt becomes the next hot thing. So you never really know what happens. And average investors, frankly, without the time to do the work, without the knowledge, without the proper sort of fortitude to invest, I think it's very, very difficult for the average investor to beat the market. So at Endowus, a bit different from Dawn, and I respect all styles. I mean, you have to most importantly, find what works for you. We believe in sort of finding a solution that works for 99% of people. And we believe that, if you look at this chart, I think it tells you just stick with market. Just buy the market and you'll do better than yourself, frankly. Not a great message to hear, especially since most people think that, what is the statistic? I think Most drivers think they're above average, something like that, which is impossible because that means everyone's average. But anyway, so another tip I have is, again, this is related a little bit to compounding, but you start as early as possible. So from the time you have your kid is born, and I'll talk a little bit about this later, but from the day my kid was born, I started investing for him. And the reason for that is compound interest is just fantastic. An example between three people here, Harry, Tom, Dick, and Harry, classic people, you know, the sergeant who always uses Tekong, right? So Harry invests 10,000 a year between the age of 25 to 35. He only goes for 10 years, but he starts really early. In total, he invests 100,000. Dick invests 10,000 a year between 35 and 55. He goes for a lot longer, invests a lot more, double of what Harry does, but he starts a little bit later. Tom starts the latest, but man, he really, once he gets going, he really gets going. Between the age of 45 and 65, he puts aside 15,000 a year. In total, he invests 300,000. But if you look at what actually happens at the end of the day when they all turn 65, assuming the same return, same market return, is that Harry ends up so much better because he started so much earlier. Even though Tom invested 3 times more money than Harry did from the outset, what you have is Harry ending up with 2 times as much more money than Tom. So I think, again, here, from the moment you can, even if it's a small amount, just start. You just got to start. That first step is always the hardest, and once you start, it gets easier from there. So start as early as possible. Market timing. One of the questions I get asked the most is, hey, it's now a good time to buy, get in the market. Hey, very scary, time to sell. Huh? So I think the team at Endowus put together a pretty interesting piece of research that sort of highlights if you were really the most sway investor in the world, what would happen. So here we have the world's worst investor. In 1973, a little bit older than all of us, than you and me at least, Dawn. In 1973, invests 100,000 right before the market goes down 37%. Wow, this person, male or female, gets damn scared and walks away. And 14 years later, finally, market looks good again. Okay, Ken puts another 100,000 in the market. Immediately, the next day, market goes down 20%, right? That's Black Monday. Oh, person goes into hibernation again. And just about another 12 years later, you know, with the internet going crazy, goes, okay, I think Ken again, market is safe again. Market's been going up so much, sure cannot die one. So puts another 100,000 in. Wow, market goes down 33% the next day. And you repeat that on and on and on, you know, hits 2007 as well. But if you really look at it and stretch it out long term, even though this person had the worst time in the world, he or she ended up with an 8.25% annualized return, which if you remember what the average investor does, that's a lot better than the average investor. That's actually 3 times better than the average investor. And really at the worst, you look at the number on the bottom right, this worst investor in the world, quote unquote, ended up with 6.33% annualized return, which is still better than the average investor. So one key takeaway here is if you want to be above average, you know, you just gotta have your discipline and don't worry about market timing. I think what we recommend at Endowus is a sort of a regular investment program. Do your work, do your numbers, figure out every month how much you can set aside, and just invest that into the market. No matter whether you think market's going up or going down, no matter what is going on in the world, just put your money in on a very regular disciplined process, and you'll probably end up a lot better than the world's worst investor, which is already so much better than the average investor. And this is just to show long-term, if you believe in the markets, if you position yourself properly, you just buy the market. You really don't have to get that creative. You know, the lower numbers, the lower returns, that's sort of US treasuries, US long-term government bonds. That's sort of the safer investments. If you're willing to take a bit more risk in terms of, and you're willing to take the drawdowns that sometimes the public markets have, the stock markets have, if you invest in stocks, you can really just close your eyes and trust that the market works. Monthly investments and over time, I think the outcomes will be fantastic. And we at Endowus also love to always sort of recommend more diversified portfolios. And the reason is that bonds do great. I think bonds are great diversifying portfolios. If you look at sort of the worst periods in history in terms of market drawdowns, stock markets tend to react very, very negatively when the economy is bad, when things are moving negatively. But bonds tend to perform relatively well. They tend to hold up well. They actually add as a counterbalance towards equities. So if you have a diversified portfolio, you can actually average, maybe even average these numbers, and you actually end up with a bit more than you would have if you had a pure 100% stock portfolio. So I think sometimes it's good to think about a diversified portfolio, especially if you are slightly less risk-seeking, if you're slightly more risk-averse, and you can't really bear or can't really accept your portfolio going down, as much as some of these drawdowns you see here. So it's good to think a bit about bonds sometimes and having that as a core part of your portfolio. And with respect on, this is where I think that most people need to be a bit more careful when they think about single stock investing. High flux. I love to use this example because it's something that hits home. Olivia Lam, I believe E&Y Global Entrepreneur of the Year at some point. Temasek was an early investor. She made water. I mean, how much more simple can it be? I mean, what more simple basic human need is there than making water, right? And in Singapore, I mean, water is a national resource. I mean, we put so much effort into it. And she was the flag bearer for water technology in Singapore and around the world. She was doing desalination plants in the Middle East and things like that. But, if you look beyond that, what actually ended up happening was quite unfortunate. I think they invested in a plant, Tuas Spring in Singapore, which went very poorly for them. And investors here, unfortunately, lost all of their money. So no matter how promising the investor looks at the start, no matter how amazing the entrepreneur, someone who literally went from living in her car to being, a centimillionaire, running one of Singapore's largest companies and being a huge global success, you never really know what happens, to companies in the stock market. So this is why, if you're not a professional investor, and I think that applies to 99% of us, this is why I always recommend a more globally diversified portfolio where a single stock is not really going to sink your portfolio. And very quickly, execution. Sorry, Dawn. I just got to do a quick plug for Endowus. Endowus, we're a digital financial advisor. We're the only ones in Singapore to offer CPF, SRS, and cash investing. What we do is we work with some of the best fund managers in the world to bring together what we think are world-class portfolios, stocks and bonds, and to allow people to hopefully realize the best returns they can. Everything is done online, and I like to think that we have the lowest costs in Singapore and around the region, actually. We work only with institutional share classes, which means really, really, really low cost. We work with the biggest fund managers in the world, everyone from Vanguard to Dimensional to PIMCO. We give advice. We help people work through sort of what their needs may be, and sit on their shoulder to work through the tough times as well. And everything we do, we do based on data, on evidence, on science. And we like to think we've really sort of changed the game in terms of costs. Before we came along, people still charged trailer fees, transaction fees, sales charges. We like to think we've sort of really, really changed the game in Singapore for the way that funds are distributed. And the one thing to highlight is that I think a lot of times when you invest through platforms that look similar to us, you're actually taking a lot of tax and currency exposure that you may not be aware of. If you're based in Singapore, I think one of the things you have to think about is how you sort of match your liabilities. And for Singaporeans, most of your liabilities will be in Sing dollars in the future. So all our investments are actually done in Sing dollar share classes, which helps you naturally hedge that exposure. You go online, you can see, if you go play around with our portfolio, you can see some of the funds we offer and some of the different portfolios we offer. And this is a little bit of what it looks like. And we're very, very transparent fees. This is literally all we charge. Everything else is at the fund manager rebated back to the customer. 0.4% per year for CPF and SRS. And I think that's the lowest in the industry, full stop. So one thing, execution, going back to execution, I mentioned earlier that I started very early for my children. Literally from the day my kids were born, I set up a goal for them. So in Singapore, it's actually quite hard to set up investment accounts. I don't know if Dawn, you had any advice on how to get around this. But in Singapore, it's quite hard to actually set up accounts for kids below 18 or 21, depending on the broker. But I wanted to start early again for my kids because of the power of compounding. And so what I did was I set up, Endowus allows you to set up multiple goals. So one can be your retirement goal. So this is my retirement portfolio. One can be maybe if you want to buy a house one day in the next 5 years, you can have a goal towards that. And I set up 2 additional goals for my kids, which are basically every month I put aside a few $100s recurring, auto debit. I have an automatic transfer on my bank account, and it goes straight into a 100% stock portfolio for my kids. Personally, I'm happy to take the volatility. I won't touch wood have to ever touch this money, so I'm willing to take that volatility to the stock portfolio. And literally every month until my kids turn 18 or 20, depending male, female, and when they go to university, this was to compound and earn the market return 7, 8, 9, 10% a year. And hopefully by the time they go to university, or by the time they decide they don't want to go to university, to Dawn's point, and they want to start a business, or they want to go pursue another passion of their own, they have enough financial resources to do that. So this is what I think I can do as a parent. And this is a really cool feature that the team worked really hard to pull together. But this is essentially helps you do that mental accounting a little bit better. Sort of what's yours and what are you setting aside for your kids. So that's my tip, sort of from an execution perspective. I've talked a lot. Dawn, back to you. I think you're on mute, Dawn. You're still on mute.
Great. Okay, can you guys hear me now?
Yes,
okay.
You're good.
Sorry, maybe going back, if I could trouble you to go back to the previous slide, I just wanted to add in one more on execution, right? So I think if you guys are tuning into this webinar now, you really need to understand what is your preferred approach. There are two easy ways to do it. You could do it in a more passive manner or a more active manner. And for myself, I am an advocate of the active approach. But honestly, if you feel that you're not the best at doing stock picking, you don't think that you have the time and energy to go and learn how to actually invest and identify great opportunities, you feel, or you're of the opinion that it's really hard to beat the market and you want to just ride on the shoulders of giants and outsource it to someone else to manage that for you, which is at really low cost, then the passive approach that Yoning advocates might make more sense. And personally, I have a lot of my friends, right, when they ask me how to invest for their children or how to invest for themselves, the first question I always ask them is, what is your goal and how much time and effort are you willing to put in? How much do you know? If their answer is, I don't know much, or I'm very busy, no time, then sometimes I just tell them, well, you might want to go and read out a little bit more, but it sounds like maybe the passive approach might work better for you. Of course, the passive investors will be like, yeah, it's easier and you get pretty good returns as well. And it's a lot more fuss-free, doesn't require as much time and effort. Whereas the people on the other end of the scale, which is the active investors, will say like, oh yeah, but you're only getting market returns. You could get so much more with others, other investments. Like if you did active stock picks and you're good at it, you could actually earn so much more than the single digits that the passive investing approach would give you. But I think at the end of the day, there's no right or wrong, because if you pick the one that does not work for you, so you could say, for example, I want to be the active stock investor, but you're not willing to put in the effort. You don't have time to potentially monitor the market and keep track with what's happening in the companies that you own, at least maybe once a year or once every quarter, or once every half a year. It's really up to you, right? But if you don't even have the time and energy to manage that, then you could end up losing money, realistically speaking. And then in that case, it might have been better for you to just go with the passive approach. And I think what you guys are doing is great, because Endowas is pretty much, I think, the only one right now, right, that allows you to use the CPF funds to invest in this mechanism versus, the usual SRS that we're all very familiar with. So if you're looking for something passive, I think the first question to ask yourself is, are you towards the passive or the active? And then the next question is, so what are the instruments in each category they can use to basically make that to get to where your goals are, to get to where you need to be. So in the last stage of our 5-step framework, so in the next slide, we basically have several resources to help you guys through. So Yoning, if I could trouble you to the next slide.
Sorry about that. Bit of a delay.
No worries. Okay. So in the resources, we presented to you guys 2 different approaches that you could use, active versus passive. So please use this 5-step framework. Think about your downsides, your goals, your objective, the knowledge, time, and tips and effort that you're willing to put in. And then the answers to these 3 will help you to decide whether the active or passive execution will work better for you. Now, after you've decided on that, you probably need to find resources to get started, right? So I'll talk about the active one, then I'll pass it back to Yoning for the passive one, since he does that. Now, the active side, you can go over to my blog. So I have this article I just published last night, and it basically talks about how you can invest for your financial future. There's also a link to an academy there where you can learn about investing, but there are many ways you can learn through investing. You can go and get educated and learn it through books. I have tons of books recommendations for those of you who are avid book readers, and you learn best from there. There's also online courses that you can sign up for. But there's also real life physical workshops, although that probably won't happen anytime soon with the COVID-19 situation. Or you could basically just try and error in the market, right? And then you can try until you gain more conviction and you learn through online resources, learning from other fellow investors, financial bloggers to understand how they approach and analyze their stocks and build up that confidence before you go in and invest. So if you want to, you're after going through this stage and listening through the webinar, you think that the active approach would work better for you and it's something that you want for your child, then you can go over to my blog and look for these resources. As for if you pick the passive approach, then over to you, Ning.
Thanks, Dawn. Just a sort of public service announcement. If you scroll down again, there's a chance for everyone to sort of put in questions. I think we're sort of going to hit the end of our slides in about a minute or two. So if you want any questions answered, if you want to ask myself or Dawn any questions, please feel free to do that. I'm also going to be very paise and sort of like my own talk, like our talk. Dawn, I think you should do the same. And I think everyone else who's listening should do that as well. So I think one question I'm just going to throw out there first, Dawn, and I'll ask you for your answer in a second, is should we top up our kids' CPF SA or should we invest in indices instead? So just keep that on the top of your mind. We've done a series of these talks. Dawn is our latest honored guest. And I think to that specific CPF question, Lou, in the bottom left corner, talks to that a lot. And he's a great speaker, very inspirational, connects super well with audiences. But please subscribe to Endow Us on YouTube. We will, again, as a reminder, do another talk next week, next Wednesday at 7 p.m. Greg and Sam will be talking, so please join us. But yeah, so execution, again, I think the Endow Us platform, I'm personally a fan of it. I put most of my money there, almost all of it actually, other than sort of that rainy day fund I mentioned. And every month when my salary comes in, it automatically goes out to a regular monthly investment plan. I personally don't have the time for it. I mean, Dawn, I'm actually curious. I mean, how much time do you spend on investing? I mean, between sort of thinking about investing, writing about investing, actually doing work on individual stock picks. I mean, how much of a curve do people have to get up if they actually want to do this themselves?
I don't have a fixed answer because there are times when there's more and then times when there's less, right? So like, for example, when the markets crash, especially in the February, March period, I was really busy because I was like, oh man, I really need to, quickly update my watch list, go and look at the latest updates of the companies and look at their latest financial statements and annual reports again. So that takes up a lot more time. Yeah, lots of time. And I was sleeping.
You have a full-time job too, right?
Sorry?
You have a full-time job too, last time I checked. Plus you write a blog.
I do. Yeah, so it is something. That's why I say it's a trade-off. Right, active investing is great. It can have a lot more returns. It's like you look at the returns that Facebook and Amazon and the rest of them have given. You're looking at in several hundreds or even thousands of percentage, and that's just insane. It's something that the index doesn't give you. But the trade-off is your time, your energy, and for some people, their sanity. So I think that's really, really important. And it's something that not a lot of people, there's so much talk on, if you had invested $1,000 into Apple when it IPO, you would have several millions now. Yeah, it's so easy to get swayed by that. But realistically, how much time and effort do you have to really balance that? And for myself, so as I mentioned, I'm quite lucky. I do a lot of my research at night, in the wee hours of the night. So I don't really sleep a lot. I sleep pretty late as well. And I would say if I really had to pin it down to a percentage, right? Maybe like 10% of my time is spent on investing, reading up.
I have a feeling you're not the normal person. So what does that mean in terms of number of hours? I have a feeling you sleep a lot less than most people.
I generally sleep, the earliest I go to bed is like 1. But now that we're working from home and I don't have to wake up to commute anymore, that's usually 2 a.m. now. Okay. Sometimes 3. I was up until 4 a.m. on the day that the oil crashed to negative territories.
I'm guessing you're spending an hour and a half to 2 hours a day on investing.
Not every day. Yeah. So I would say maybe every week I would spend at least maybe 1 or 2 hours every week, minimum. But if that's a great opportunity, then it's a lot more. So if I have, for example, before I invest, it could take me anywhere between 6 to 12 hours to just research. And that's just one stock alone. And I think one thing that not many people share is, for me, because I'm really strict with the criteria and the kind of stock that I invest in, especially if it's for long-term holding, I say no a lot more than the yes, right? So I think
saying no is one of the most important things in life. I mean, you have to know when to say no to things. When I worked in private equity, We literally would say no to 99 out of 100 deals, and I think saying no is the most important thing, actually.
Yeah, exactly. But it's frustrating, right? Like, you spend so much time. But I give you an example. I was researching this stock previously during after the market crash because I thought, hey, it seems like there might be opportunity. And when I look at the financial statements, I look at the business model, the management, and then I was like, oh no, I don't think it's something I want to hold for long term. It might be a speculative bet. I could still make money out of it, but I don't know if I could react and respond in time. And so, like, I spent at least, I think, 4 hours before I could make that conclusion. And I was like, oh, dang, I just wasted 4 hours of my life. I could have been playing my kid, or watching like some Korean drama or something else, whatever, right? And that's something that a lot of people don't understand. They think that investing is just like you just pick, but there's a lot more for the really good investors as well. When I talk to a lot of people, I realize it's about saying no most of the time and only yes a small minority of the time.
Absolutely.
Value the time to do other things like exercising, watching dramas, or supercharging your career or growing a side hustle. Then maybe investing actively may or may not work for you. I don't know. But at the end of the day, I always believe, try it out. Go and get educated. Go and try it out. And it's not too late to like maybe try with a smaller amount first for like 6 months or 1 year, and then you understand yourself better. Because the way you manage your money in the market is very different from when you have a paper portfolio or what you think you would react, right? Everyone's gonna say like, yeah, confirm buy low, sell high, confirm. And then they look at that like that really nice slide you had about the world's like unluckiest investor. They'll be like, stupid lah, I won't do that. I confirm I will hold one. I won't be so silly. But when it really comes down to it, no, that's exactly what people do, right? Amazon has gone up so much, but honestly, how many Amazon early investors are still holding on?
Actually,
after it had like 50% gains and they were like happy, yay, I made 50%, bye, I'm selling off, haha, who are these fools buying from me? And then after that, they're like, shucks, I should have sold. I would have been up 1000% now if I didn't. So realistically, it's the emotions and that journey that no one can really do for you. And I think that's why, a lot of people don't understand this when it comes to investing, but that's super important.
Yeah. No, I think you're absolutely right. I think there's one data point I love to highlight sometimes, which is that there was a research piece put up by an internet broker in the US, and they found the people that done the best are the people who lost their passwords. So literally the people who could not buy and sell when they wanted to. I think you touched on a very important point as well, and I think this speaks to the active versus passive approach. I think the passive approach works personally for me a lot better for a lot of different ways. I mean, one is just I have so much less time to invest into this these days with 2 kids and the startup. Secondly, I think sometimes individual stocks, when you have individual stocks in the portfolio, it can be a lot more volatile. I mean, if we looked at sort of what happened in the financial markets the last 1 or 2 months, literally, I mean, the index was down 30% in less than 30 days, right? I mean, individual stocks, I mean, there was stuff that was down 50, 60, 70%. I'm pretty sure that most people don't actually have the fortitude to hold through these types of rides. And I think that's actually what it takes, I think, to be a phenomenal investor on the other end. And frankly, for me, I think that emotional roller coaster, having to wake up, if let's say you're investing in US stocks and you're waking up 2 a.m. in the morning and, on your way to the bathroom, put out your phone and you see a stock's down 20%, you're like, oh my God, I want to kill myself. Right? So that emotional roller coaster is really tough to deal with, especially when there's so much going on, so much else going on, kids and the magical, the terrible twos and things like that. So much to look forward to. But yeah, so actually, it worked really well. So I'm going to do this one more time. If you scroll down a little bit more to the bottom of the page, there's this top button, which everyone should click. It actually doubled since the last time I mentioned it. So I'm going to talk about it one more time. But yeah, so very quickly, Dawn, question. So should we top up kids' CPF SA account or invest in indices instead?
So for me personally,
yes.
I think it really boils down to objective, yes. Right? And I see the CPF like a bond. So you're right, bonds are pretty great instruments as well. Yeah. But for me, I already look at the CPF with bond, and the problem is that it has very, very low liquidity. It's not something you can just withdraw. Yeah. So I think if you top up your kid's CPF, then just be prepared that you can't use that for a pretty long period of time. And versus, let's say, investing in, and CPF is at about like 4%, right? If you invested elsewhere that could give you 4%, I think passively could decently give you 4% or more as well. And you can liquidate that when you need or when you want to. So I personally would not top up too much into my kids' CPF. Whatever's in there is great. I may put in a sum of money to allow it to compound over time, but it wouldn't be my primary focus.
I think that's absolutely fair. I think one way to think about it is, your SA account will compound at 4/5% depending on whether you have a bonus 1%. And my personal view, again, long term in the stock markets is in a fully diversified portfolio is anywhere between 6, 7, 8, 9%. So if you're thinking about 30, 40, 50 years out, especially if you don't need to touch the money, then you have the ability to earn quite a bit more. That compounding really, really works in your favor. And also, if you invest outside of CPF, you have that liquidity. That being said, I mean, 4 or 5% is fantastic. For some people, it's risk-free. I mean, I think Singapore is the most risk-free sovereign country in the world. So I would take that bet that it will still be there in 50 years. So it just depends on sort of your preference, the amount of risk you can take, and how much volatility you can sum up as well, I think, and what you're trying to get to here. Looking for 100% bulletproof, I mean, there's nothing guaranteed, but that's probably a bit closer. Sorry, you were saying?
I think that's spot on. And also when you mentioned about that, I just had another thought, which is opportunity cost, right? Because if you put it into CPF, you could put it elsewhere. So you need to pay that trade-off as well.
You can never take it out, right? Yeah. So it's a long time. 55? So what was the
55 / 65, right? Depends on the circumstances.
Yeah.
Okay, no. Might be earlier because you could technically use it for your housing. No, wait, but that's OA, so no, it doesn't work. If you're doing OA, you can't use it for housing.
That's right. So Kenneth asked the question about dimensional funds, DCA, etc. I think we love dimensional funds. Just a quick primer, basically. Dimensional funds, they were the ones that invented smart beta. The equities funds that we work with overweight certain factors that over time have been proven to outperform. Most of it is based on research from Nobel Prize winning economists. So things like value, things like profitability, things like size. So size, as a simple example, they have a view that long-term small / mid-sized companies do better than large cap companies. And I think the easy explanation to that is there's more room on the upside for growth versus large cap companies, which may be sort of at the tail end of all of the growth and fast expansion phase. But they sort of buy the world and then they slightly overweight these factors. We think they're great. We think they do really good work. But that's a quick sort of over primer on dimensional. We like them. And we, through Endowus's platform, you can actually do sort of dollar cost averaging. You can set up a monthly recurring and sort of just buy in every month sort of with the net savings that you have from your income. Yeah, so gold. Wow, that I haven't dealt with yet. Do you want to address the gold question or should we skip that? Pass that to
the gold one is interesting. It's something that I've been thinking a lot recently as well. Because I think with ever since the Nixon took the US dollar off the gold standard, there's just been nothing holding them back from printing more and more money, and government debt has gone up so much, right? And I don't know. I think for me, right, I feel for gold in terms of the unlimited QE that the US and governments worldwide are doing. I feel that could potentially push up the value of other asset classes that are more limited in that sense. And I think gold is a great place. I'm not personally invested in gold, but I think it's a good way to hedge. And if you're a believer of the permanent portfolio, where you have asset allocated to different, like 4 different parts, right? And gold could be one of those 4, then why not? It sounds like a pretty decent way of structuring it. There's also, so I'm actually trying to organize another webinar with one of my friends as well. So he works in cryptocurrency. And if you ask him, he feels that digital gold is going to be even better than gold. So I'm not an expert on that because I don't work in the scene, but I'm trying to understand a little bit more from him and invite him potentially on. He's actually tuning into this webinar right now. So Aaron, if you're hearing this, please say yes to the webinar and we can discuss that. But I think it's an interesting question to really think about because with all of that unlimited printing, eventually the dollar is going to lose its value versus the past, right? I mean, it's not as valuable anymore compared to how it was used to be. And there's also that huge uncertainty as to how much longer the USD will be the reserve currency of the world. We're starting to see in the international politics scene, China is coming up a lot. And from what I've read, China is also trying to pioneer their own digital currency. And they're trying to basically become the next reserve currency. We don't know that they're going to be successful. But if they are, I think that's going to affect the value of the USD. And if more countries start to transact in China's currency or any other country's currency, then that might affect, right? So the USD wouldn't be as powerful as before, and that's when if people start losing faith in that, then gold could potentially be worth more. But at the end of the day, the key thing is, I don't know, but I think it's a great hedge to have in your portfolio, and if you believe in that thesis, if you're of that opinion, and looking at the permanent portfolio as one potential way to structure it, then why not? It seems like a pretty decent approach.
So here is when I'm going to take a leaf out of your book and say, I don't know, and I'm going to pass on gold. Crypto, unfortunately, Dawn, I'm going to take a pass on that as well. And so, again, I think all of us have to know when to say no. I don't know, even more importantly. So I think that's, we're pushing 80 minutes at this point, so I think we should probably let everyone go.
And just one more question that I thought deserves addressing. So I see Derek mentioned that a monthly recurring, how to do a monthly recurring and endow us when the minimum sum to start is $10,000. You have an approach around this, right? So why not you go ahead and share with us how you do it?
No. Look, I think Derek has a very good point. The minimum sum at endow us is slightly higher at 10,000, and that's because we want people to take investing seriously, and we believe that everyone sort of really puts their mind to it to set aside that amount of money they can do it. We have a minimum of 10,000, and after that, there's actually no minimum on the recurring. So I think Derek might be a little bit confused on how that works, but there's no minimum on the recurring after that. So after the first 10,000. So Derek, happy to take it offline. Feel free to send me an email directly as well. Thank you again.
In on that as well. One way of doing it is because I love the way how you guys are able to structure different portions of the portfolio, right? So, if someone has, for example, for that $10,000, am I right to say that they could technically use that to split between their own retirement portfolio and their own?
Absolutely. So that's across the different pockets. So I mean, for most people, I think people have a pretty large amount of CPF set aside. So CPF, SRS, and cash. SRS is definitely something you look into if you're paying taxes, a decent amount of taxes in Singapore as well. So that's across all pockets. So hopefully it's something that's relatively achievable for most people, even if some people are slightly more cash poor because of expenses, especially child related, as we all know. Hopefully they have that in the CPF. So, but yeah, it all counts towards it. So yeah, so that's my plug for endow us, and that's how I do it. Again, one of the biggest mistakes that most investors or most people make is that they keep most of the money in cash, and I think that's one of the most dangerous things you can do, because over time that inflation really eats away at it. The hardest step is the first step, is really taking that first step to invest if you've never done it before. So what Dawn said exactly, that first step, even if it's small, just take that first step, bite the bullet, invest however you see fit, whatever platform you want to use, whatever strategy you want to do. Just take that first step, and after that, I guarantee it'll be so much easier, right? If you listen to Lou's talks, his first step was the hardest, and after that became so easy, right? So take that first step.
And I think as parents, we need to really start taking that first step, because the earlier we do, the more time we have to understand ourselves, our emotions, and our investing journey as well. And that's going to be really valuable, because imagine if you just let the inertia overwhelm you and you just wait, and maybe you decide, maybe when your child is maybe in secondary school, right? And then you're like, okay, I think I should finally start investing for his college fund. Then you're playing with a lot less time, you have less time for it to compound, and you might still need a few years to kind of understand your investment strategy and methodology, and as a result, you're going to lose even more time. So I think what you say is exactly spot on. Regardless of what you pick, whether you start an investment portfolio with Endow Us or any other platforms out there, or even going down the active stock pick method, at least do something first. Because I spent quite some time learning and understanding myself, and I thought like I was really calm when it came to money, and I wouldn't take speculative bets. And it took me experience and time in the market to realize that I still had that side of me, and I had to put that under control, right? And I think that journey is really important. So the earlier you start, the better it is.
Great. Well, I think we've taken up enough of everyone's time tonight. So thanks again, Dawn. Really appreciate you joining us, and hope to be back again soon. And again, everyone, please like us. That thumbs up sign at the bottom, and please feel free to click into some of the links below. Yeah. Hopefully, see you all soon again. Thanks, Dawn. Good night.
Thank you. Good night. Bye.